Hello, ladies and gentlemen. It's Jesse Colombo, Cyber Trading University's Forex and Futures instructor. And we have a very interesting closing bell today with Jeffrey Smith of DTI. He's going to be teaching the mistakes that traders make, and he's going to be discussing all the different types of mistakes and how to avoid them, including how to trade with a plan, dealing with expectations, using proper discipline, focus, and avoiding overtrading. So he'll begin in about a half an hour, actually 25 minutes, and I will be doing my Forex and Futures update right now. So right now, as usual, we're looking at the S&P 500. You can see it keeps on rebounding. It rebounded right off that support level right there at 2040, level I've been showing for quite some time. Just there's some upside momentum. It keeps heading on up. It seems like it's going to try to reach its old high or prior high, which is the resistance level, which is right around 2,120. That's the highs that we saw back in early March and also mid-March. So I want to see if it's going to try to reach those old highs. Let's take a look at the Dow right now. 1 second. Here we go. Just bounced right off 17,600. And also likely to probably hit its old highs right around 18,300. It could be forming a wedge here. That's also what I'm watching for. But I want to see a confirmed breakout above those early March highs as a confirmation of any bullish action. So I'll be watching that. Let's take a look at the NASDAQ 100. You can see it's rallying even more strongly than the others. Tech has constantly been a very strong sector, much more vibrant than industrial sectors or conglomerates and other blue chip stocks that tend to dominate the S&P 500 and Dow. So you can see it's trying to most likely gun for its prior highs right around 4,480. Let's take a look at the Nikkei. There we go. Japan's Nikkei stock average right here. Still climbing that channel. There was a false and unconfirmed breakdown over here. You can see it tried to break down, was unable to break below 19,000. It's a key psychological level. And that also happened to be the high of the consolidation of early March. It pulled right back, formed a candle pattern called a hammer. This is what I'm going to be discussing in my workshop tomorrow, my candlestick workshop for Cyber Group subscribers, basically showing different patterns like this. But this is called a hammer pattern. You can see it rallied right off there. So now it's actually above 20,000. And that's a key psychological level. It also broke past these highs, or the prior highs that we saw back in mid-March. And the yen is weakened against the dollar, so that tends to be bullish for Japanese stocks. So I want to see if that trend is going to continue. I'll be showing you the dollar-yen chart shortly. And I actually placed a trade on that. I'll show you what I'm looking at. So now it looks like there's a good chance that the Japanese Nikkei stock index is going to try to reach the top of this channel. It's hard for you to see up here, but if you can just visualize, it's probably going to try to gun for that and then maybe pull back. At some point, there's going to be a breakout or breakdown from this channel, but for now, it seems to be respecting this channel and rising up and down within it. Let's look at the dollar index. Here we go. So you can see US dollar index still within that channel. Looks very similar to the Japanese Nikkei channel, though on a different scale, but you can see the implications are the same. I've been saying I was skeptical of the dollar pullback. I know a lot of people on Wall Street and financial journalism were calling for the end of the dollar rally, but I was skeptical because there was no technical breakdown. And I was saying that it looked like there was some sort of a pennant or triangle pattern forming. And what do you know? It's actually breaking out now. So this is very interesting, what's happening here, not just for Forex, but the implications for commodity futures, because they trade inversely with the dollar. So now I want to see if it's going to try to do basically what what we just saw the Nikkei do, even though they're not closely related, but I'm just using this to show you an example of this technical principle of how markets oftentimes climb in a channel. So you can see it tried to break down, and now it's just bouncing right off there. I want to see if there's going to be some sort of a measured move of a similar magnitude from what we saw back in late February and early March. So, and of course, if it breaks down from here, or is unable to break above the recent high or the high that we saw back in mid-March, then the trade would be negated, of course. So I just want to see a solid follow-through, but you get a nice vibrant candle here. I want to see if there's going to be a continuation of that. You can see this is the euro versus dollar. Bumped its head right on that resistance zone from 1.11 to the dollar, and also 1.1 to the dollar. You can see it was just a thick resistance zone, not a single level, but a zone. You can see these long upper candles kept on trying to basically break above, was unable to do it, and here we have a breakdown. So now there's a good chance it's going to try to reach its prior lows. That's typically what markets do. They'll try to reach prior lows will be a support level, so that often ends up being a price target to watch. And of course, the breakout in the dollar confirms this breakdown in the euro because they trade inversely. Let's look at the dollar yen. So I've been watching this wedge pattern in the dollar yen form, this consolidation, for a few months already, and there's been no confirmation yet. I did place a small initial trade. I'm interested in the idea that if there is a continuation in the dollar's appreciation against the yen, and because of this ongoing stagnation in Japan's economy, that Bank of Japan is going to come out with another renewed QE program, or at least basically give the program a boost. And there's been some speculation about that. So, of course, I'd want to see it break above 122 for a real confirmation. I placed a small trade just with the idea of maybe scaling in initially, basically upon a breakout right over here. So I want to see how that plays out. Of course, if it doesn't, if it corrects back, where is it? I'm just trying to find you. So a breakout right above here, and I took the trade. So if it pulls back, it drops back below, I'm out of the position. But for now, I'm interested in this thesis, but of course I'm willing to change my mind and cut my losses if need be. All right, let's take a look at the Canadian dollar. Where is it? Okay. You can see over here, just similar to the dollar yen, it's within this consolidation zone. Really no confirmation just yet, but it is strengthening because the overall dollar, the US dollar index is strengthening. So once it finally breaks above or below one of these levels of 1.28 or 1.24, I think there's going to be a solid run. Of course, I want to see it confirmed by the US dollar index itself and see that all the technicals line up. And also, what's interesting is that this consolidation or stagnation in the dollar Canadian seems to be quite correlated with oil, because the Canadian dollar is highly exposed and levered to oil. You can see oil continues trading within this $10 trading range between $54. This is West Texas Intermediate crude oil. Still within that trading range between 54 and 44. You can see it bumped its head right at that 54 level like it did many other times. And now it's selling off. Of course, strength in the dollar is punishing oil, at least in the early stages. I just want to see if there's going to be a solid break above or below as a true confirmation. There's a chance that oil is trading within this, possibly within a channel. It's not. It's a little bit early to tell, but I'm watching that just because I'm curious about how that plays out. But I'm not seeing a real confirmation with oil yet until one of these support or resistance levels are broken. And I'd like to see the dollar confirm that. Let's say if there's a breakdown in oil, I want to see bullish action in the dollar because they trade inversely. And let's say if there is a bullish breakout with oil, I want to see the dollar pull back, because that'll tend to give oil a boost. And that also affects the Canadian dollar because it's correlated with the Canadian dollar. So let's look at the British pound. Here we go. I've been showing this 1.5 resistance level for a few months now. You can see it kept on bumping its head, unable to break above. Then I said that I was seeing a possible pennant pattern right over here. And now we got a breakdown. So this is interesting. I want to see if this is going to have legs, if it's going to continue. Looks like 1.47 is the next hurdle that I want to see it break. That's the support or the recent lows that we saw in mid-March. So I want to see if there's going to be a real follow-through to the downside. This could be a good short, of course. I'm not recommending you do it. And of course, always use a stop loss. But this is interesting, and especially if, let's say, there's a further lift-off in the dollar index, of course. So keep your eyes on the British pound. Let's look at the Australian dollar now. Still within that range between 0.76 and 0.79. Really no confirmation either way. Just keeps on bouncing up and down within that range. So I'll let you know if I see anything interesting going on with that. But so far, not seeing it. All right, let's look at... I haven't taken a look at the New Zealand dollar in a while. It's kind of a mess. It tends to be a more volatile currency. I wouldn't recommend it for beginners, but not really seeing a real clear trend there anyway. So, all right, let's look at gold now. I know Lori likes to look at gold. I do too. I'm a gold bug, but I'm of course a tactical trader. So I trade with the trend first and foremost, regardless of what the fundamentals are saying. Let's see. All right, so you can see gold was falling within that channel pattern. Bounced right off 1150. That was that support. And of course, strength in the US dollar is hurting gold. It's really pretty self-explanatory if you know those relationships, of course. I'm watching to see if gold is within a channel. I don't know yet, but I want to see if there's some significance to this channel. You can see these long upper wicks over here. Gold has had a hard time trying to break above 1200. Key psychological level, was unable to do it, rejected it several times, and it's below it again by just about $5.50. So I want to see if there's a continuation or a follow-through in the US dollar, if it's going to punish gold, and maybe see if gold tries to retest its recent lows. Let's look at silver now. Silver's really breaking down hard. Not too surprising given the dollar strength. You can see why I use the US dollar to pretty much play off commodities one off another. It's just all intermarket analysis. You can see these long upper wicks. These are known as shooting star patterns. It's another candlestick pattern that I watch. And this often happens when there's a rejection of a certain price level. You can see it happen multiple times, so it's more confirmation. Silver tried to rally up above... Pretty much it's rejecting the 17 level, $17 per ounce level. That's really what I'm seeing. It's the key psychological level. And was unable to do it. And then it failed, and now it's dropping. So now the immediate price target I'm watching are the recent lows right around $15.40 to $15 per ounce, assuming the dollar strengthens. I want to see if it's going to try to retest these recent lows. All right, any other markets you want to take a look? I know Greg was saying he was interested in soybeans, I believe. Here we go. We can take a look at soybeans. He actually farms soybeans, which I find very interesting. Just going to get you another chart. 1 second. Let me know any markets you want to take a look, and we can do that. Here we go. My pleasure, Greg. Here we go. Soybeans down quite a bit, down 1.72%. Here we go. So, as I said, I'm not really seeing a clear signal either way. I showed on the weekly that there's a chance that there's some sort of a triangle or pennant pattern. It seems like it's been basically converging along the psychological level right around 1,000. So the prior trend was down. And as I said, if you can just draw, I can't do it with these particular charts, but if you can just draw these lines where they converge, I want to see how this consolidation pattern plays out. And the commercial hedgers of smart money here in green have actually a significant long position. They've been long really for about a year or so, but if you notice the last few times they went long, there was a continuation to the upside. So I think that's worth noting. Of course, the last few times the commercial hedgers of the smart money went long soybeans actually more aggressively. They did it at a much more rapid rate. Whereas here they've been long for a good 7-8 months or so. Sorry, maybe actually a little more than that. I'm sorry, maybe about 9-10 months. But I still respect their opinions, of course. All right, any other markets you guys want to see? Let me know. I'm really watching a lot of these currencies, and I'm just interested in that possible Japanese yen play. I just want to see if there's going to be another wave of the Abenomics program. A lot of the Japanese economic data has been coming in weak, and there's been some more speculation that Bank of Japan's going to ease again. They do this kind of like how the U.S. did QE1, QE2, QE3. Well, Japan's doing the same thing essentially. Every time there's a slowdown or signs of disappointment, basically Bank of Japan eases, and it causes another wave down in the Japanese yen. So, and there are some analysts who believe that the Japanese yen is going to weaken much more significantly. That just because they have so much debt that the only way to really finance their spending and to try to prop up the bond market is by doing these QE programs, essentially printing money. And people who are skeptical of that type of action, including myself, believe that there's a good chance that the yen could weaken much more significantly from here because of that. So it's an interesting longer term play, but it's also known as a widow maker. At least betting against Japanese government bonds has been known as a widow maker because so many people have tried to short Japanese government bonds, but they keep on rising. Even though they have so much debt, bonds keep on rising, and rates keep on going lower and lower and lower, defying these predictions of people who are looking to short it. So it's definitely a paradox, but of course it's because there's just so many savers and a lot of elderly people in Japan who just have so much money and they don't want to invest in riskier assets, so they just put into Japanese government bonds. All right, so if you folks want to if you have any questions or you want to take coaching with me as usual, you know the drill. Just email me at jesse@CTU Trading. And I'll be basically setting up for Geoff to start in about 7 minutes. So I'm looking forward to it. See you guys soon. Take care. Hello, ladies and gentlemen. I'm excited to have Geoff Smith from DTI on for our closing bell today. He's going to be discussing the common mistakes that traders make, which is something that's relevant to all of us, no matter if you're an amateur, a newbie, or a veteran. And he's going to be discussing how to avoid those mistakes by trading with a plan and how to manage your expectations, use proper discipline and focus, and to avoid over trading, something that so many traders do, and it really is the bane of our existence. So very excited, and I'll be watching this with great interest. Thank you so much for coming on, Geoff, and you can start your presentation when you're ready.
Hey, Jesse, I like how he said that. Yes, I can light up a mouse just as good as anybody. The problem is keeping my hand off of it sometimes. The market really tries to call us in, and it's like the market sirens. We have no mask to tie ourselves to, so we end up going click anyways and just trying to create a trade when we don't really need to. Good afternoon, everybody. My name is Jeffrey Smith. I am the Chief Instructor here at DTI. We're located in Mobile, Alabama. Well, we always have to have this slide first. There's risk in trading. How's that? You can lose money, and really that's the one thing that I've always thought was interesting. A lot of people, I mean, when they come into trading, especially newer people, they don't expect to lose. As a trader, you have to expect to lose, just because you're not ever going to be 100%. So we have to expect to have a loss here and there. Hopefully, it's not a lot of them, of course, but we will lose every now and then. And the thing is can we minimize the loss and maximize the gain? There it is. So we cannot ever be 100%, but we do have to be able to cope with losing. And hopefully once we get through this, we'll have a better understanding on how to do that. But past performance is not indicative of future results, which at times is a good thing, because we don't want to keep losing. But at other times, we wish we could win a whole lot more, right? So a little about myself. I'm the guy on the right side. The founder and CEO of DTI is Tom Busby. He's been trading in the markets since the late 1970s. I've been in the markets since about the mid to late 1980s. I went through the school of hard knocks for the most part. My dad actually took me under his wing and decided to help his two sons learn about the market, and he actually had a stockbroker named Tom Busby, who was Vice President Smith Barney in Oklahoma City, where I'm from. And he actually kind of helped us learn a little bit about futures and stocks and options and things of this sort. We actually got sent off to an investor boot camp in Provo, Utah, put on by a gentleman named Howard Ruff, and we got to learn all kinds of stuff from gurus between penny stocks and futures and chart reading. Actually met John Bollinger there. That was pretty cool. And when we got back from there, he sat us both down, wrote us each out a check for $10,000 and said, make money with it or not, it's up to you, but I'll never give you another dime. And he stuck to his word. He never gave us another dime. I went off, got a couple of degrees in engineering, was a pipeline engineer for 10 years, but I was waking up at 3 o'clock in the morning, trading the index futures up until about 6:30, 7 o'clock in the morning, going to work all day, checking out stocks at lunchtime, and get off work, spend time in the evening with the family, and doing that day in and day out. Tom started a school down here in Mobile in 1996 and asked me to come down and help him out. And I liked my job too much, so I kind of turned him down. That went on for a couple, 3 years, but I went to trade shows with him and things of this sort. And finally, in 1999, they had moved me up into management. I was just a big babysitter, and by that time, the market had really become a hobby of mine. I'm really intrigued by how things move and why things move and how they get from point A to point B. And he, I guess, called me on a bad day and said, hey, come down here. And I said, fine. So in 2000, I packed up my family out of the Panhandle of Texas and moved here to Mobile and been teaching and trading ever since. I've traded in just about every market. Haven't traded every vehicle by any means, but I've traded a lot of different things. I'm more of a commodity trader than I am in anything else. I like trading the meats and softs and grains, probably for the most part. Energies some, and index futures I dabble with every now and then. like equity options, and like trading stock a little bit. So I kind of dabble in a little bit of everything, but I like the commodities probably more than anything in the world just because it's something that we use each and every day. I mean, you think about sugar. Well, we have sugar in a lot of things. Some people don't eat sugar, but you think about cotton. We wear cotton clothes, right? You look at coffee. I love coffee just because I drink it every day, and life doesn't begin until after a cup of coffee, in my opinion. So, and that's just the thing. These are things that we use each and every day, so why not pay attention to them and maybe try to make a little money with them. So anyway, I want to kind of go through some mistakes that we make. A lot of people focus on, look how great I am, but we always run into, look how bad I did. And we're always trying to figure out why we did poorly, or what our ghosts in the closet or skeletons in the closet are coming out and trying to make us do bad things. And the thing is, more than anything in trading, you do have to be disciplined. It really doesn't matter what you trade. And I mean, I heard Fausto say this yesterday in a webinar, and I agree with him 100%. You can buy a stock, and the only thing you might know are the letters of its symbol. You don't have to know what it makes. You don't know how good the corporation is. But if it moves from point A to point B and you're long, hey, you made money, and that's all that really matters. So there's a lot of things that we trade that we don't know what they are, and I'll be the first one to say it. I have bought stock that I thought was one thing and it was another. I heard him talking about, just a quick example on TV, talking about Peabody Energy. This has been 4 or 5 years ago, and they kept they always use abbreviations. They were just calling them PBG, Peabody Energy Group, and going on and on and on and on. So I got to the office and typed in PBG and stuck it in my quote page. Started watching the thing, and I was like at $29. I was like, what the heck? So I bought 300 shares just to see what it would do. And literally in about a week and a half, 2 weeks, that thing was trading up around 33, 34 bucks. And I was just like, man, this thing is just in smoke mode. Well, come to find out, they were talking about it in our trade room, Peabody Energy. It was just cruising, and I typed in, yes, it is, I'm long. And they said, where are you long from? I said, 29. They go, wow, you're doing really great because it's out at 56. And I said, no, it's not, it's at 33. And I said, no, it's up at $56. And I said, no, it's at 33. And so I went to look at what I bought, and I bought Pepsi Bottling Group or something like that, as opposed to Peabody Energy, thinking that it was a totally different company. Still made money with it, but there it is. So that's the thing. We can do all of that. But we want to go through, focus on markets, overtrading, and decision making and things of this sort. So let's kind of get rocking and rolling here. First of all, we can't do anything without making a plan. Trading is a business, and businesses follow a plan. Therefore, we must do the same thing. And really what a plan is doing is giving us some sort of pathway to achieve a goal, is really what we're trying to do here. Trading is a mental and emotional game. If you kind of weed out the emotional side, the rest of it, which is about 90% of the game basically, 10% of it is just figuring out what to buy and go and click. If we could stop second guessing ourselves, if we could stop, thinking this thing might go against me, that's the one thing that we always have to look at. And I will kind of build that as we go through this. So stick with me a little bit, and we'll help build that little business plan. So the plan should cover aspects of trading, and I try to make a plan each and every day. What am I going to trade? And if I do trade it, at what price am I going to enter? And if I do get long, or if I get short, where's my stop going to go? And not only that, where am I going to be taking profit? The thing is when we're trying to buy something or sell something, a lot of people just get into it and never know where to get out. They don't know where they're wrong, their ouch point or their tilt number or whatever you want to call it, and they never have that in mind before getting into a trade. You always got to know, if I buy this, where do I think it's going to go? That way, if it gets to that point, you can get out, and it might go further. Flat out, it might just keep going and going and going. But in your plan, you were expecting to go from point A to point B. So we need to put into our plan, and this is more like a daily plan as opposed to a monthly or a yearly or something like that, what I'm looking to buy and what I'm looking to sell and what news are coming out today. Economic news is going to move a market, is going to affect the market that you're trading. Today we had World Ag Supply come out at noon Eastern or 11 Central. That moves grains around. They didn't really move all that much off of it. It was kind of a blah report, kind of the same as last month's report, which is fine. But they did move some. And the thing is when I see that, well, I know I'm going to be trading grains today just because, well, the World Ag Supply is going to come out. I got long wheat, I got short soybeans, made a little money off both, not a whole lot, but I made a little money off of them. So, and that's the thing. In my plan today, that was what I was focused on. And I didn't make any other trades today. I traded wheat, I traded soybeans, and that's the one thing I did. So that's the thing, when we start developing a plan and start looking at a plan, we have to kind of figure out what we're going to trade, where we're going to trade it, why we're going to trade it. When you look at it like a weekly plan, you have to lay out your week. And I do that based off of economic news. If you're looking at a week that has very, very little news, that means the market's going to trade on its own merit. So there's going to have to be some international news or something, because our news isn't going to be doing anything because we don't have any. And usually you'll see, and this is one week to really kind of pay attention to, the second week of every month is kind of light on economic news. We'll have a piece here and there, but there's really not much economic news, usually our second week of our month. The rest of them have all the CPIs and PPIs and the retail sales and the housing indexes and things of this sort, but we're kind of really, really light. So you have to kind of focus on certain times and say, well, I'll look to trade here or trade there, or maybe you have stocks that are having news that you can trade as well. So, but you need to start setting up what you're going to be doing every day and every week. Trading too large. I hear people say you can't make money trading on one lot. I totally disagree. You can make money trading 100 shares of stock. You can make money trading one option contract. You can make money trading one futures contract. And you can make a lot of money doing it. But most people like to trade multiple contracts or multiple shares because they can scale out easier. But the thing is a lot of people look at the market as a money machine, and it can be, but when they get dollar signs in their eyes, they sit there and they over leverage their account, which if they're wrong, that will kill an account. So what you have to do is start very, very, very small. All right. When we start looking at the trading large numbers of shares or contracts, and this is one thing that I really hate new traders to do, is actually to win, because then they don't have the fear of losing. I actually trade better if my first trade in the day is a loss. It's just me. If I lose, all of a sudden I get this reality check saying, hey, look, you lost. Now get it in gear or you're going to have a red day. I don't like red days. So I usually trade better if my first trade's a loss. If my first trade's green, well, I like that too. But I always think that, well, I've got money to lose if I'm on this next trade. That's not the way to look at it. So, but you'll have very, very wild swings in your account. You can be up $5,000 or $6,000 or $7,000. The next day, you can lose $5,000 or $6,000 or $7,000 or $8,000, and then you can make $4,000 or $5,000. I mean, it's just up and back and up and back. The one thing you need to do is to start out small. Start with a contract or 100 shares or a one lot or whatever it is, and earn your right to grow. So if you win for a week, the next week you go to 2. If you win that week, you go to 3. Win the next week, you go to 4. Earn your right to trade more. I actually have a student who does that every week. Monday, he starts with 1 contract. If he wins that day, he goes to 2. If he wins the next day, he goes to 3, and he builds up. If he ever has a losing day, he goes back, starting with 1 again. It's really interesting. But he's done that because he knows that he can get out there and trade, a 10 lot or 15 lot or 20 lot and really start getting beat up. So start with a small account, earn to trade more. If you're building it up that way, the more money you have, the more you can have quote unquote in margin. You can be a pattern day trader, and of course they're going to give you 4 times the buying power. But a lot of places, if you have over 100,000, they'll give you 8 times the buying power. So when you start looking at getting that right to trade more, that's because you're making money. You don't want to trade more if you're losing money. You can dig yourself a bigger hole. So watch out for that. Unrealistic expectations. Well, I want to make $1 million today. Probably not going to happen. We can put all kinds of stuff out there. Man, if I could just make 5,000 a day, I could pay my taxes. Well, what do you think? Is it going to happen or not? Probably not. When we start looking to trade, we have to look at realistic expectations. If you think about this, if you make $500 a day, there's 250 trading days in a year. You can make $125,000 a year. So now, if you live in New York City, that might not be enough. If you live in Mobile, Alabama, you can have a very nice life off that. So it all depends on where you live, whether that's a lot of money or not. But the thing is it doesn't take a lot every day to compound itself into something that's very large at the end of the year. So if you're making $100 a day, you can make $25,000 a year, nice supplemental income. If you're making 200, it's twice that, and so on and so forth. And of course, this is an average per day because you're going to have some days that you make more. Of course, you're going to have some losses along the way also. But when we start looking at trying to say how much I want to make, it's different than how much I need to make. If you focus on the need side, hey, I really need to make $150 a day and I ought to be okay. Focus on that. If you're constantly beating it, fine. And then you'll find that, hey, I can probably make $200 a day, and then $300 a day, and then $400 a day as your experience gets better. So, but it takes time to get to that point. And a lot of people think they can just jump right into a market and make a whole bunch of money. And at times you can, don't get me wrong. But the other times, odds are you can't. And you're going to have to learn it. You're going to have to get educated. You're going to have to learn from somebody. And someone who's been in that market, someone who can teach you about that market. That's what Fausto does here. That's what Tom Busby does at DTI. We teach people how to trade in various markets. There are no experts in various markets. Tom's very good when it comes to futures, and he's pretty good on equity options. You look at Fausto, he's fantastic when it comes to stock, but I know he trades futures too. So everybody trades a little of everything, but we seem to be experts just in one field or another. So, but learn from the guys who've been there, the guys who are smart, the guys who have been through the hard knocks and been down in the doldrums, emptied an account, came back and said, okay, I can do this the right way. So, but there is no holy grail. When you start looking at trading systems, trading methods, using MACDs and RSIs, nothing is going to work 100% of the time. There it is. It might look like it's working, and all of a sudden it starts to fail. And it might be because of economic conditions. It might be because of the different news items. It might be just that the market is out of sync with itself. And that does happen. A lot of people like to know why the market went up and why the market went down. It really doesn't matter why. I mean, it's just like economic news. You'll have non-farm payroll come out first Friday of every month, and everybody's always asking, what's the news? What's the news? What's the news? Well, who cares? Knowing the news, is that going to make your trade any better? No, the market's already moving or moved. If you missed out, then you missed out. So concentrate on when it's coming out, not what it is. You'll see, someone was asking me today that, why is the Hang Seng, just skyrocketing the past 2 days, 3 days? And I was just like, well, I don't know. I don't pay attention to it because I don't trade it. And come to find out, apparently China came out and said, hey, 401k mutual plans, mutual funds and stuff like that can now buy Hong Kong stocks. Well, you got all this money in China flowing into the Hong Kong market buying a bunch of stocks. So it's pushing that index up. There it is. But if you're long the Hang Seng, you're making money, flat out. But take time to learn what you're trading. Don't just start trading something because, hey, it's brand new. You're going to have to start trading it sometime, but learn about it before you do it. Now, this is probably, I don't know if this is my worst enemy, but I think what I do is kind of a result of this. I have a tendency to overtrade, and that's because of the lack of discipline. I set goals for myself each and every day, and if I achieve the goal early, I have the worst time in the world the rest of the day. If I make one trade and pick up, 700, 800 bucks, I'm pretty happy with that. Why trade anymore? So, why try to give it back? Yet, I'll try to go click somewhere else. The big thing that people will do also is never trade without a stop. Never trade without a stop. But I see people all the time. Well, I was long crude oil. I went skiing last week. When I came back, crude oil was down, $5. Now I'm getting killed here. I'm down 5,000 per contract. What am I supposed to do? Well, if you would have had a stop in, that wouldn't have happened. And that's the thing. Never trade without a stop. Protect yourself somehow. Sometimes not using one works. I'm not going to be the first one to tell you that. But usually you'll be happy that you had one. It's just some sort of protection. You don't have to use a protective stop. You can actually buy a put. Marry a put to your position if you're long, or marry a call to it if you're short. Offset it with some other thing. If you're long an option contract on some equity, some stock, put a stop in based off the underlying. If the underlying reaches this price, get me out of my option. There's various ways of protecting yourself in a position, but always find some way of doing that. You'll find that if you can manage your risk, the reward will come in the end. The thing is, a lot of people don't want to manage risk because they don't want to admit that they lose. I've lost many a trade. I'm not scared to tell anybody that. And it's really funny. You get in these trade rooms, and you make a good trade, and you'll have a couple of people say, "Hey, nice trade." You make one bad trade, and you'll have the whole bunch of them say, "Stopped out, lost, da da da," and they start pounding on you. Well, I can't win them all, and nobody else can either. But people are very quick to react to losses, but to gains they almost expect it. Where I always look at it the other way around. I expect to lose every trade because I don't know if I can win or not. I don't have a crystal ball. I would want to believe that my experience is good. So, yeah, most don't mention their bad trades. I agree with that, Wayne. But I think mentioning them is a good thing. It's good therapy just because you can realize, hey, I can lose. But the thing is, you're going to have to learn to cope with it sometime. So why not just admit that, hey, you made a bad decision, and now we're going to learn from it and try not to make a bad decision later. And that's the thing that we have to do, is try to figure out how to make that, not make that same decision. I mean, think about the definition of insanity. Doing the same thing over and over again, trying to, expect some different expectation, right? Well, it's not happening. So we have to change sometimes. Even though we have a system or a method, we have to kind of pay attention to say, hey, why isn't this working? And go back to kind of the basics of it and say, is it the fundamentals of what I'm doing is wrong, or has the market changed to where these fundamentals don't work? And then we're going to have to try to tweak it to do something else. Always pay attention to how things are working. It's a very, very, very big thing. Yep, huge regret. And I agree. And regret can really kind of pull us down some. Lack of focus. I see a lot of people, you'll be doing this, that, and the other, or telling them, hey, let's get long here or get short here. And then you see them there, and all of a sudden they go, what's the trade? Well, they're not paying attention. A lack of focus. Having the TV on, to me, is a huge distraction. I don't care if it's CNBC, Bloomberg, or whatever. Now, if you're trying to see, what POTUS is saying, or what this announcement is, or something along those lines, okay, fine. But just to have that background noise, to me, would be very, very distracting. You need to pay attention to what the market is doing, what your market is doing, what your trading is doing. If you're in a trade, pay attention to it. If you're in a swing trade or a longer term trade, check on it. It should be doing what the rest of the market's doing. If it's up and your trade's down, something's wrong. So you can't concentrate on too many things at once. Think about your portfolios. Most people can manage 5, 10 stocks, maybe pushing 15 if you're kind of well versed in it. But I see people with portfolios of 30 and 40 stocks. Why? I mean, they're trying to grab a little bit of everything, I guess. That's greed. So why not skin it all down to something you can manage, something that you can pay attention to. If you don't like this one, pitch it and get another one. But that's the thing. Always try to trade with something that you can manage. One thing that I always tell people, they always say, well, what's too much? What's too much size? Well, if I can't get up and use the restroom when I'm in a trade, then my size is too much. That's the way I look at it. If I have to sit there and go through that pressure also, the heck with it. I mean, I'd like to be able to get into a trade and say, oh, I need to go do this, and I can go do that with the expectation of my plan working out right. But if I have too many contracts on, and if I don't want to get up and leave, then I know that I have too many contracts on, and I'm uncomfortable with it. So always beware of what you're feeling. A lot of people disregard how they feel about things. Your gut is actually pretty smart. And if you listen to it, you'd probably figure out very quickly, hey, I don't like this, I need to get out. Or, hey, I like this, I need to stay in it. But yet, you'll do the absolute opposite. The market will start to pay you, and your reaction is, get out, take the money. As opposed to, once you stay in it and see what it does. On the other side of that, the market starts going against you, your gut says, get out, this is going to hurt, and yet the other side says, stay in it, it might turn around and go back. So listen to your gut. A lot of times it's right. Sometimes it's hard to hear it, though, because we have other things going on. But we do need to kind of simplify things a little bit. Start out with no 100 shares, one contract of no options or futures or whatever it is, and again, start building from there. But don't put your hands in too many bowls. Don't buy stock and sell puts and flip around and buy a S&P futures contract and go over here and start trying to short crude oil and maybe get long hogs. I mean, it's just that's just too much to watch at one time. So you start looking at one market and then slowly grow. With your experience, you can get into various markets at one time. It could be one trade. You could be long the S&P and short bonds and long Apple and, selling covered calls against it. There you go. Something like that. But, but once you find the intricacies between the markets and how they would kind of work together, you'll find that you can do that. So, just checking my time here, see how I'm doing. Overtrading, I can do this no better than anybody. I can trade and trade and trade. I just love being in the market. I love trading. I love going click somewhere. And I was born with a mouse in my hand. I'm 50 years old, and I can click with the best of them. I can keep up with anybody on a mouse in a trading platform. But you need to spend more time observing the market as opposed to being in the market. You can learn a lot. There are some days you sit there and you can't figure out what to do. You can't figure out if you ought to be getting long or getting short. Those are the days that you need to sit there and watch some more. Why force a trade? You can start increasing contracts or share sizes instead of trading the same amount. I say be consistent. Trade 100 shares for a while. If you feel like you want to trade 200, fine. Go to 200 and trade 200 shares for a while. But don't sit there and bounce around everywhere. Don't trade 500 shares on this one, and 100 shares on that one, and 1,000 shares on that one, and 300 shares on this one. There's no consistency there. Be consistent in everything that you do. That way, you already know how you're going to trade it. If you buy 300 shares, I can take 100 shares off here and 100 shares off there and let 100 shares ride. You trade 1,000 shares, I can take 400 shares off here and 400 shares off there and let 200 ride. I can finance my stops trading more shares, but that's the thing. Be consistent in everything that you do. When we start looking at our plans for each and every day, this is what I want to trade, this is where I want to trade it, let's see if it gets here. Usually overtrading is taking that plan, wadding it up, throwing it in the trash can, and totally disregarding it. Just because what happens, really, is that you have your plan laid out, you see a market moving, you reach over and go click, and you lose money. And you then go, well, I need to get that back. So now your mind is off the plan and on the I got to get it back feeling. So you click again, you get long or short, whatever it is, and then now you have a bigger loss. And you're like, God, I can't have that kind of a loss. I'll tell you what, I'll just get back to where I was and I'll just call it a day. So you make another one, boom, lose on that one as well. Now you're starting to dig a hole. And now we start to get into panic, and panic never solves anything, and off you go. And then you look back over the plan and say, wow, if I would have just followed my plan, I would have been just fine today. But when we start looking at overtrading, overtrading can hurt us a lot. But I will say this, there are days that you can't lose a trade. Those days don't come often, and when they do, you need to take advantage of them the best you can, because they make up for a lot of the loser days that you've had in the past. I'm a firm believer that there are some days that it doesn't matter. You can close your eyes and click on something and make money with it, just because you're just totally in the zone, if you will, or the market's doing exactly what you expect it to and is paying you. You do have days like that. And having days like that is good, but they're, like I said, they are very few and far between. Yeah, there are definitely days you can't win. And what's really interesting is you might have days or even several days in a row that you can win every trade you make. But you'll find that losing streaks last longer. Why that is, I have no idea. But it will really beat you up. You have a losing day, and you have a losing day, and you have a losing day. You finally have a winning day, then you have another losing day and another losing day, and you can't figure out what you're doing wrong. At that point in time, you need to take some time off. Take a couple of days trying to figure out what you're doing. Talk to another trader saying, this is what I'm doing, what am I doing wrong? They might be able to give you some insights. And there are times where I can't buy anything and get it right. I just have somebody fade everything that I say. Why it happens, I have no idea. But you'll have times where you do very, 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 very well. So that's the one thing that you have to always beware of. How's your trading going? This is something that you ought to do, is go to Office Max or Office Depot or whatever, and get one of those big, yearly, the write-on calendars with the little erasable markers, and get a green one and a red one, and take each day, if you like trading intraday, take each day and divide it in half, and put a red dot, on half of it for the morning, and a red dot on half of it in the afternoon, or a green dot and a red dot, or a green dot. So you can see if you're trading well in the mornings or if you're trading well in the afternoons. Circle the day with green or red if you won that day or lost that day. One thing you will find is an interesting pattern. You might find that you do great in the mornings and you lose it in the afternoons. Note to self, don't trade in the afternoons. Problem solved. Or vice versa. You might be an afternoon person, not a morning person. Look at the days, and as you do this over months at a time, you might find that the third week of every month is really hard for you. Well, that's options expiration week, so you might go light during that week. You're trying to find patterns in your trading. And if you can find those patterns, this will help with your overtrading, but be your discipline, because now you can sit there and say, I shouldn't trade trade too much during this time period because I always have a tendency to have problems. You'll find me Thursdays, whatever it is on Thursdays, Thursday's my worst day trading. There. I know that. I win some Thursdays, don't get me wrong, but I don't like trading on Thursdays just because Thursdays have a tendency to beat me up. Notice I told you earlier, I traded the grain report today. That's the only trades I made. Just because I know what Thursdays are like. I made a little money, I'm happy. But you'll find cycles in your trading. You might find that the month of July is your worst month every year. Okay, take a vacation, go somewhere, go hit the Rocky Mountains and enjoy the cool weather, whatever it may be. Find out where your good spots are and your bad spots are. Monopolize on the good spots. Stay away from the bad spots. That is the best thing that you can do to try to figure out what you are doing, okay? So, but always pay attention to that. I would say finally, a lack of education. Of course, I teach people how to trade. Fausto teaches people how to trade. But I'll be the first one, and I'll bet you he will be too. You have got to learn about the market you're trading. And you got to learn it from somebody who's been there, looked at it, traded it, and gone from there. Learning markets is one thing. Learning a method is another. Getting used to it. Learning a trading platform. My goodness. I don't know how many people I've seen come through my classes and they go, I don't have a trading platform. Or, I just got this trading platform, I lost $400 today, but I couldn't figure out where to get a stop in this thing. Learn your trading platform before you do anything in a market. Make sure it's a sim account and just plug away on it. Figure out how to move orders, cancel orders, make orders, put in orders, change the order types, change the quantities, all of that stuff. If you're well versed in your trading, huge hurdle. Then you start working on the education and the system, method, whatever it is side of it. So now you can start trying to figure out how this works as opposed to struggling with the trading platform. That's an education in itself. But screen time, market time, is probably one of the best educators there are. There's 250 days, trading days in a year about. So you have 250 days to start learning how these things work. But different times of year act differently. Okay, you have different markets in the fall as you do in the spring. You have different markets in the winter than you do in the summer. Markets just act differently. And you're going to have to learn those different cycles in the market from year to year to year. Some stocks don't care about those. You have, what do they call them, the cyclical stocks. Depending on economic times, some stocks do better or worse or whatever it may be. That's true too. Think about Hershey. Hershey does chocolate. Well, when do people eat chocolate? Well, usually starting about Christmas, and then you have Valentine's Day, you have Easter, and then that's the chocolate days, right? So the winter months is a great time to own Hershey. Outside of that, Hershey's just hoping somebody has a birthday or an anniversary or something like that, right? So, but you're going to have stocks that move based off of times of year, based off economic cycles. So always beware of those when you're starting to look at various markets. There is no one magical approach. We can sit there and say, hey, here's a method for trading, but that method is compiled from years and years of learning about various markets. This is what I was taught. This is what I was taught from this person and that person and this person and that person. Basically, we're trading off of experience and what we've learned throughout life. So that's the thing. You're going to have to start gaining that experience too. That's where screen time really comes in. Seeing what you like and don't like. And the thing is, it's about liking and not liking. You're going to have somebody say, you need to trade this. Well, yeah, but you might not like it, I don't like carrots. Never have. I won't eat carrots. Sometimes I have to because, I'm at somebody's house eating dinner and I don't want to be rude, right? But I don't care for carrots. If somebody says, here's a carrot, eat it, I'm going to say, no, thank you. But it's really good, and it's really good for you. Well, no, thank you, I don't like them. There it is. Trading's the exact same way. You're going to find things you don't like. So don't trade them, because trading needs to be fun. Trading needs to be enjoyable. If you don't like what you're trading, you're not having fun, and it's not enjoyable. So if you don't like it, leave it, period. Find something that you like. I teach people how to trade futures. I know a lot of my students trade stock using futures. They don't like trading futures. Fine with me. But futures are a 24-hour market. Stocks are not. So they have a great indicator in trading their stock now. Fantastic. Love it. Because they found out what they like. They found out what they don't like. I have ones that just trade options. Fine. But they're finding what they like and don't like. Always trade what you like. The ones you don't like, you might have to trade it every now and then just because, but usually you won't. So, let's go through some things very quickly. that makes a trader successful, since we've been beating ourselves up here lately. Preparation. This goes back to our plan. We need to prepare ahead. We need to be looking ahead, seeing what we want to do. We need to have some sort of a pre-market planner. Something that our plan is I think there's going to be support and resistance here. I'm going to see if I can't get long here. I'm going to put my stop here. I'm going to look for resistance here and probably take profit there. If we break through that, we ought to go up to this next key resistance. We're staying inside of this channel, so I'm going to see if I can't buy it at the bottom of this channel, see if I can't sell it once we hit to the top of this channel, so on and so forth. We need to look for news. We need to look for our support and resistance numbers. And of course, we're going to have some sort of a method to say I need to be getting long at this point or short at this point or something like that. We also need to have some sort of detachment. The market doesn't care that my kid had a wreck at the school parking lot this morning, okay? The market does not care if my hot water heater went out this morning. The market does not care if I'm having to go to my CPA's office and get my taxes done. The market's going to be there. It's going to open and close at the same time every day. If you cannot detach yourself from the stuff that's going on in your life to sit down and focus on trading, don't trade. Go deal with the stuff, get it off your mind, and then come back and trade, all right? You're going to have to detach yourself from the other things. This is your job. If you can't focus on your job, you won't do a good job. And if you don't do a good job, you're not going to get paid for it, okay? So, trading's stressful. Go find something to do, okay? You're going to have to find something to relieve stress. I work with wood. I turn wood. I make furniture. I do stuff like that. That is how I relieve stress. I make pens and bowls and high chairs and stools and all kinds of cool stuff. I enjoy doing it just because it gets my brain off of market stuff. But when I'm on the market, I focus on the market. So you need to look to trade methodically and get the emotions out of the way. Attitude of abundance. Remember, there's always going to be another trade. Barring God coming to get us, there's going to be another trade. If you miss the opportunity on this trade, guess what? I just have to wait, and another one's going to be coming by. It's just like a train. You miss the train, there's going to be another one coming by. Don't chase it. A lot of people get that left out feeling. They'll buy the high, and they know they shouldn't have. Or they sold the low, and they shouldn't have. It's okay. If you get left in the dust, there's going to be another trade. Now, that trade might not be till tomorrow. That trade might not be till next week. It might be in the middle of the night. But there's going to be another trade. So don't worry about being left in the dust. And consider all the great trades that you had. You know, when we start looking at, had a losing day today. But, yesterday I had a really good day. Try to keep your mind on the positive things. Keep your mind off of the negative things. And courage. We all have some fears that are out there. There's some people, I've met on both extremes. They can't go click on a mouse. They're scared to get into a market. Or they have absolutely no fear of getting into a trade, but they can empty an account and they just don't know when to get out. They were getting paid. They stayed in too long. They ended up losing money. Getting in is not the hard part. It's getting out of the trade that's the hard part for them. Some getting into a trade's really, really, really hard, just because, well, they're scared to lose. That's okay. Get into the market. See if you're going to lose, but you're going to have to manage it. We have to be able to move past the fear, look to the good side. And think about this very quickly. A lot of people look at risk and reward. I hate that little equation they have. Wherever I get in and put my stop as my risk, and if I look for this much profit, that's my reward. That is way, way, way too simplistic. Because you don't put you into the equation for starters. And number two is, what's the probability of the trade working? Because I'll tell you this, if I can just make the equation real simple here. If I'm risking $1 in a stock to make $2 in a stock, a lot of people say that's a good risk and reward. It's 2 to 1. There it is. Well, if I told you that the odds of making that $2 was 20%, would you take the trade then? Now, let's switch it around a little bit. If I told you that 80% of the time you can make $1 in that stock and put a $2 stop on it. Now, the risk reward's backwards here. I'm risking 2 to make 1, but it's 80% probability to win. So which one are you going to take, the 20% or the 80%? I'll take the 80%, not the 20%. Because if I lose $1 8 times, that's $800. And if I lose twice, I make $400, so I have a net loss of $400. That's on the 20% win. But on the 80% win, I make $800, I lost twice, I lost $400, so I have a net profit of $400. So even though the risk reward is flopped, the higher probability wins. And that's the thing that we have to look at in every trade. What's the probability of the trade working? Okay? So don't worry about risk reward. And think about this too. If a market never goes against you, what does the stop mean? 0. It means nothing, nada. So the definition of a good trade is one that never goes against you. Keep that in mind, because if a trade never goes against you, you're not going to lose, right? So definition of a bad trade is what? One that never goes in your favor. Note to self, if you buy something and it never has gotten above your entry point, bail the thing, because, well, it's not, you can always buy it again later. Always remember that. I can always buy it again later. It's just not working now. So always think about A, risk reward, B, probability, and has it ever gone against me? I mean, I had some folks in the class, what was it, last October? Yes, it was October. Amazon's earnings came out. They were trading at like, I don't know, it was like $315. They dumped them off to $285. And I was just like, I bet you they take this thing back up. So I told everybody to buy the April, now this is back last November, 300 call on Amazon. And it cost us like $7, $8, I think it was. And I thought, there, well, where's it 12? Maybe it was $12. But anyway, we bought that thing, and I said, now, we're going to try to get past the next earnings in January. And if we can get past the next earnings, we'll see how far we go. Notice where Amazon is right now. It's up at 383. I told everybody, get out on the 1st of April, or if it gets back below 360. We got to the 1st of April. We got out, somewhere around 375. So we had $75 of intrinsic value on that option. The option never went against us, ever. It went from 285, went up to like 290 in 2 days, and then it was chewing around and finally got about 300 and off it went. And then it came back down. Actually, their other earnings came out and they dipped them back off again. And I told everybody, hey, if you got out of that option before, buy it again because it's probably going to go back up. But anyway, that's the thing. One that never goes against you, you can stay with it a whole lot longer because what? It's still paying you. As long as it's still paying you, stay with the trade. Now, the problem is options expire, futures expire, stock does not. So beware of your expiration. You're going to have to be out by then anyway, right? So see if you can get from point A to point B very, very quickly. But anyway, back to courage here. Be courageous enough to embrace your trades and enjoy them. Love them to death. Finally, number 5. We already kind of covered this. Discipline, 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 discipline. You know, a great method will only work as well as its application. If you apply it correctly, it will work. If you cowboy it, do it from the hip, it won't work all that well. People like to break rules. I'm smarter than this is. Well, somebody spent years and years and years perfecting it. Why try to do something against it, right? Be consistent in your approach. Use the rules set by yourself. Your rules are going to change, which let me say this very quickly. Do not change your rules inside of a trading week. Do it on the weekend because you're just going to confuse yourself. If you're going to change something, change it on the weekend. Fine, if you don't like it and you don't want to trade the rest of the week, fine. But you want to do it when the market's not there, so you can think about it and say, let's try this and this and this and this week, and then trade it. Trade it for 5 days. If it worked better, fine, tweak it again the next weekend. But always change your plan on the weekends, never during the week. That way you don't have to worry about what the market's doing. So let them work for a while. You have to be consistent. You got to be persistent. Okay? So, and just remember, you're as good as your last trade. You might be a winner. You might be a loser. But look at trading as a whole, all right? Look at the past 1,000 trades. And how did you do over the past 1,000 trades? And I'll tell you this, I am a 79.8% trader. You know what that means? I'm going to lose 20% of the time. So if I have a loss, I chunk it into the 20% pile. I know I'm going to lose 20% of the time, so fine, be that way. But I know that I'm going to win almost 80% of the time. So always keep that divided. It's a glass half empty, glass half full thing. I'd rather look at it as half full as opposed to half empty. If you consider yourself a loser, you're going to become one. You need to stay positive. Always think positive. Positive mental attitude is what people always say. But it's true. If you're not upbeat and positive and smiling and shaking people's hands and how are you and love you to death, then you're probably more pessimistic, and that's going to come into your trading. I mean, yeah, I had a losing day yesterday. I'll probably suck again today. That is not the way to come into a trading day. You come in, had a losing day. I know what I did wrong. Today I'm not going to do it. I'm going to do it this way instead. That's a positive way. But losing is part of the game. We have to review our losses and move on. But we always want to look at the gains as well and want to do that more, always. Okay? So, I'm done. I'll put it that way. Thank you all for tuning in. If you all want to, tomorrow I'm going to open up our trade room. If you all want to tune in for 3 hours, I'll be in there starting about 7:30. You also hear a gentleman named Steve Thompson. He is our morning moderator. So you'll hear him going through our trading morning and trying to get long and short and this, that, and the other. But I'll be in there to kind of introduce things and tell everybody about who we are and what we do and start going from there. But if you want to do that, I guess I can paste this. I don't know if you can click that link or not. There's that link. But it's free, doesn't cost you a dime. If you want to come in, click that. You can get into the room and go from there. So if you think you can, you're right. So I'll do that, Grant. Thank you. But thank you all for tuning in and being with us and all that good stuff. I thank Fausto and his group for having me in. They're a great group of folks there at Cyber Trading University and all that good stuff. So, but you all have a great and wonderful day. And if you're traveling, be safe.